Let's jump right in. Today, we are completely demystifying the ICAI accounting standards that tend to trip people up the most. If you're gearing up for the CA intermediate exams, you know exactly what I'm talking about. We're cutting through the textbook noise and breaking down the exact exam standard scenarios you need to master. No fluff, just the structural understanding that actually gets you marks.
Here's our game plan for this explainer. 1. Cracking the ICAI exams. 2. Allocating joint costs. 3. Fixing prior period errors. 4. Capitalizing borrowing costs. 5. Calculating purchase consideration. And 6. Final exam takeaways.
Starting off with Section 1, cracking the ICAI exams for the September 2025 to May 2026 cycles.
This right here is reality. These are the actual instructions from the advanced accounting paper. And look, we all know the stakes are incredibly high, right? Understanding the examiner's mindset is literally half the battle. We're not doing pure theory today. We are tackling high-yield exam standard scenarios, the exact compulsory and descriptive questions you're going to face in that pressure cooker 3-hour window. So let's get our heads in the game.
Moving to Section 2, allocating joint costs, specifically finding that 3-to-1 ratio.
Okay, imagine opening your paper and seeing this massive, intimidating joint cost block of 623,700 rupees. Honestly, a number like that can instantly induce panic. Your task? Allocate this chunk of change between two joint products, FP1 and FP2. But how do we actually do that logically without second-guessing ourselves?
Well, it's all about determining the basis for allocation using the sales value. It's actually a pretty elegant calculation. You just take the output in units, so that's 3,000 for FP1 and 1,600 for FP2. Multiply those by their sales prices per unit, which are 160 rupees and 100 rupees respectively. What does that give us? A total sales value of 480,000 rupees for FP1 and 160,000 rupees for FP2. Once you simplify those big scary numbers, boom, you're left with a perfect 3-to-1 allocation ratio.
And that elegant little ratio leads us straight to our victory number, 467,775 rupees. Since our ratio is 3-to-1, we just take 3/4 of that intimidating 623,700 rupee joint cost we started with and allocate it straight to FP1. This is exactly what the examiner wants to see, a totally clear, logical progression from raw data to a mathematically sound answer.
All right, on to Section 3, fixing prior period errors under AS5.
So what happens when historical accounting mistakes come back to haunt your current period? Your ultimate weapon here is paragraph 16 of AS5. It lays out clearly that a prior period item results from errors or omissions. The scenario we're looking at gives us a highly specific, very realistic example, omitting 2 entire pages of inventory details. You have to keep this definition in your back pocket.
Let's break down the fix. The error is that on March 31st, 2024, inventory worth 20 lakhs was just completely omitted. Missing pages? Poof, gone. Now, according to paragraph 19 of AS5, these items are normally included in determining the net profit or loss for the current period. So, the solution is immediate and direct. You have to add that 20 lakhs straight back into the opening stock of April 1st, 2024. It's a totally clean, standard-backed fix. No overthinking required.
Next up, Section 4, capitalizing borrowing costs, dealing with qualifying assets and multiple borrowings.
Okay, take a deep breath because this is the boss battle of the explainer. Before we crunch any numbers, we have to lay down the absolute golden rule. Under paragraph 3 of AS16, a qualifying asset is one that necessarily takes a, quote, substantial period of time to get ready for its intended use or sale. This even explicitly includes inventories that need substantial time to become saleable. If it doesn't take substantial time, it absolutely does not qualify for interest capitalization. Keep that locked in your mind.
And here is exactly why that rule matters so much. Look at the raw complexity of the RM Limited scenario. It's a dense wall of text. You've got a company pulling a term loan for a building, then a bunch of multiple non-specific borrowings, and they're spreading these funds across buildings, furniture, machinery, and a factory shed. When you see a problem structured like this on exam day, you have to know it's explicitly designed to overwhelm you.
So how do we cut this down to size? First thing, we categorize this massive block of debt to lower our cognitive load. We isolate the one specific borrowing, which is the 12% term loan of 50 lakhs, strictly meant for the building. everything else, the debentures, the 15% term loan, the intercorporate loan, that all gets tossed into a bucket of non-specific borrowings. Separating these streams is the absolutely critical first step to getting AS16 right.
From there, we just walk through the examiner's logic step by step. Step 1, identify the qualifying assets. The problem tells us the building, plant and machinery, and factory shed took a substantial period of time. Great, they qualify. Step 2, and pay attention because this is the trap. Exclude the non-qualifying assets. The scenario notes the furniture was purchased directly from a local manufacturer, meaning it was ready immediately, zero substantial time, therefore no interest capitalization for the furniture. Step 3, capitalize the interest on the qualifying assets for the substantial period ending March 31, 2025. Follow those steps and you completely dismantle the trap.
Let's speed into Section 5, Calculating Purchase Consideration under AS14. Let's test your mechanics on AS14 for a second. When a company is acquired, what exactly happens on the balance sheet if the purchase consideration paid just doesn't match the actual net assets acquired?
The calculation here reveals the answer beautifully. Let's say we have a purchase consideration paid of $1,512, but we deduct net assets worth $1,609.60. Basically, we acquired more net asset value than we actually paid out in consideration. This mismatch leaves us with a negative figure of $97.60. And that specific negative $97.60 cements a huge fundamental rule of AS14. When your purchase consideration is less than the net assets acquired, you do not book negative goodwill. No, that amount translates directly into a capital reserve. It's a fundamental structural difference, and remembering it is the only way your accounts are going to balance. Finally, Section 6, Final Exam Takeaways and Mastering the Fundamentals.
We have covered some incredible ground today, right? From wrestling with joint costs and prior period items to decoding borrowing costs and purchase consideration. We've looked at them in isolation to really nail down their specific mechanics. But remember, on exam day, these aren't just isolated formulas living in a vacuum. Think about it. A prior period inventory error affects your profit, which then affects your reserves, which hits the exact same balance sheet where you're trying to figure out capitalized borrowing costs. So how are you going to connect these dots? I'd challenge you to look beyond the individual rules and see the entire interconnected puzzle. Because mastering how these standards interact, well, that's what turns a student into an expert accountant. Keep pushing, stay incredibly focused, and go absolutely crush those exams.